In this video, you're going to learn exactly what stable value funds are, why they're quietly outperforming high-yield savings accounts right now, how they actually work, who should be using them, and how to find one inside your own 401k today. Let's get into it. Most people think they only have two options inside a 401k when they want to play it safe. Either put money in a money market fund, which feels boring but safe, or just leave it sitting in bonds. But there's a third option that most people completely ignore, and it's called a stable value fund. A stable value fund is an investment option offered inside many workplace retirement plans. It's designed to do one simple thing: protect your money while still earning a decent return. Unlike a stock fund that bounces up and down every single day, a stable value fund holds its value. The price per share essentially never drops. That's the whole point. What makes it different from a money market fund is what's actually inside it. Stable value funds typically hold a mix of high-quality bonds and contracts from insurance companies or banks. Those contracts are specifically designed to smooth out any price swings. So even when bond prices drop in the broader market, your balance inside this fund doesn't fall. Think of it like a savings account that's protected by a very sophisticated financial backstop. Your principal is safe, your return is steady, and the yield? Right now, it's actually beating what most banks are offering. But here's the part most people don't know. These funds have a special advantage when interest rates start falling, and that's exactly where things get interesting. You've probably heard that the Federal Reserve has been cutting interest rates, and if you have a high-yield savings account, you've already felt the pain. Banks move fast when rates drop. One day you're earning 5.2%, and a few months later, you're looking at 4.1%, then 3.8%, and the slide keeps going. That's just how variable rate accounts work. They follow the Fed almost immediately. Stable value funds work completely differently, and this is the key insight that most people miss entirely. When a stable value fund earns its return, it's not just following today's interest rate. It's earning a blended rate based on a whole portfolio of contracts and bonds that were locked in over time. Some of those contracts were made when rates were high. Some are newer, but because they're layered together, the fund keeps earning that higher blended average for much longer than a bank account would. This is called crediting rate lag, and it works heavily in your favor during a falling rate environment. While your high-yield savings account is already adjusting down to whatever the Fed did last month, your stable value fund is still paying out that higher blended rate from contracts set months or even years ago. In practical terms, this means that right now in 2026, many stable value funds are still crediting somewhere between 4% and 5%, while high-yield savings accounts have already drifted down in response to rate cuts. That gap is real money. And it brings up the obvious next question: how exactly does this thing protect your balance in the first place? So here's where stable value funds get a little technical, but stick with me because this part actually matters. The reason your balance never drops inside a stable value fund comes down to something called a wrap contract. Here's how it works. The fund buys high-quality bonds, just like a bond fund would. Now normally, if interest rates rise, those bond prices fall, and you'd see a loss in your account. That's what happened to a lot of bond investors in 2022. It was brutal. But stable value funds have a special insurance wrapper around those bonds. That's the wrap contract. An insurance company or a bank steps in and essentially guarantees that you can always withdraw your money at full book value, meaning what you put in plus the interest you've earned, regardless of what the underlying bonds are worth on any given day in the market. You never see the volatility, you just see a steady, growing balance. Now, these wrap contracts aren't free. The fund pays a small fee for them, usually somewhere between 0.1% and 0.3% per year. That's already baked into the yield you see. So when a stable value fund says it's earning 4.3%, that number is already net of that insurance cost. What you see is what you get. The result is something pretty rare in investing. You get better than savings account yields, zero downside risk to principal, and predictability. But this naturally raises the question of whether there are any catches. And yes, there are a couple worth knowing about. Stable value funds sound almost too good to be true, so let's talk about the real limitations, because there are some. Understanding these will help you decide if and how to use one. First, stable value funds are only available inside tax-advantaged retirement plans. You cannot buy one in a regular brokerage account, an IRA, or a Roth IRA opened on your own. They live exclusively inside employer-sponsored plans, like 401k, 403b, and similar plans. so access depends entirely on whether your employer offers one. Second, there are withdrawal restrictions called equity wash rules. If you want to move money out of a stable value fund, you generally cannot move it directly into a competing investment like a money market fund. You have to move it first into something like a stock fund or bond fund for a period of time, usually 90 days, before shifting it to a competing fixed income option. This prevents people from gaming the system. For most long-term retirement savers, this is no big deal, but it's worth knowing. Third, these funds are not FDIC insured. Your protection comes from the wrap contract issuers, not the federal government. The good news is that the institutions writing these contracts are typically very large, very regulated insurance companies and banks. Failures are rare, but it's technically different from a bank guarantee. Finally, not every 401k offers a stable value fund. Smaller company plans in particular sometimes skip them. But many large plans absolutely include one, and millions of people are sitting on this option without even realizing it. Which leads us to the final and most actionable part of this video. Finding a stable value fund in your 401k is easier than you might think. Log into your retirement account portal today. Look at your investment options list and scan for anything with the words stable value, capital preservation, or fixed income guaranteed in the name. Some plans call theirs something like Guaranteed Income Fund or Preservation Fund, so look for that language. Once you find it, check the current crediting rate. This is the yield the fund is paying right now. Compare that number to what your savings account is paying. If the stable value fund is higher, and in many cases right now it will be, that's your sign. Now think about where this money makes the most sense. If you have a portion of your retirement savings that you're planning to use relatively soon, or if you're close to retirement and want to reduce risk without sacrificing yield, stable value could be a smart parking spot. You don't have to go all in. Some people use it for just a portion of their bond allocation. Others shift more into it specifically when they believe rates are going to keep falling. Either way, now you know it exists and you know how to evaluate it. If this video helped you see your 401k options differently, hit like right now so more people find it. Subscribe if you want more straightforward retirement content that actually explains how things work. And drop a comment below. Does your 401k have a stable value fund? Go check and let us know what yield you find. I'll see you in the next one.